welcome to the Monday Futures Market Outlook for July 23rd, 2012. This is Patrick Sresna. For those of you that have not had the opportunity to try out the eminisource.com trading room, complimentary memberships are available on the website. As always, we start off with a chart of the U.S. dollar index, and we continue to be predominantly bullish the U.S. dollar. And while there have been numerous periods of consolidation in the last month and a half, we primarily are still distinctly bullish and have been looking for further strength in this with the follow-through that we've seen Friday, followed by this morning on Monday. We continue to support this bullish outlook. We're looking for 85 to 85.50 as our first target, but there are a number of moves that even measure it up to 86.50 on the upside. Once that is underway, if it is lines up with a collapse of the Eurozone, there could be even further upside. While we certainly are identifying the first upside targets, if their situation deteriorates substantially, there are even scenarios where we could see the U.S. dollar return up to the 90 level. But let's take it one step at a time and just see if the U.S. dollar can follow through on this breakout over the last couple of trading sessions and reach our first targets on the upside. Next, I want to take a look at the Euro FX, which is predominantly where all the weakness is coming in and making the U.S. dollar so strong. The Euro continues to deteriorate, and we continue to see weakness downwards. Our bigger picture target for even the year was around the 118 to 120 level, which is just a couple hundred pips below here. That is where we're looking for the initial supports to come, but there are scenarios where we could see that Euro deteriorate all the way down towards 115 on the downside if things really accelerated on the short term. Next, I want to take a look at the 30-year Treasury bond, and whether it's the 30-year or the 10-year bond, we continue to see bullish breakouts. We remain predominantly bullish the 30-year Treasury bond and are looking for Treasury bonds to continue to rally. If we do get the solid break of this 152, 153 zone where all the highs came in over June and July, if we get this breakout, the first upside target will be the 157, 158 on the upside. But we could see even as high as 162 if there's really a momentum gain out there. In the much bigger picture, even though we have a thesis of being predominantly long bonds or bullish long term, we do believe that if the upside became very fast and accelerated, that actually could bang out even a long-term top. And while we certainly are very predominantly bullish for even the next 10 handles higher, at some point, if this thing really gains acceleration, we may at some point flip-flop and actually recognize the limited upside potential that bonds will have at much higher levels. Next, I want to take a look at copper futures, and copper we were suggesting could even see short-term strength up towards the 360, 370, but inevitably we were looking for this pattern to fail, and that didn't disappoint. The two-day reversal that we've seen now on these copper charts is continuing to suggest that we're going to see further weakness. We are predominantly bearish copper and are looking for moves that still could test even as low as a $3 or even $2.90 level on the downside. And if we see a predominantly strong U.S. dollar and weak markets, the weakening of copper is very likely. Next, I want to take a look at crude oil. And crude oil had a very robust rally last week that now has resulted in a distinct reversal. While last week we suggested that the crude oil could rally even as high as 95, 97, but a rally up into the mid-90s, even the 92 target where was the 50% retracement was natural in this rising wedge. But it was likely that once crude oil finished this move, that it would resume and at minimum come retest that 75 to 77 zone. There is a scenario where we could see crude oil break even as low as 70 or even 65 during an aggressive sell cycle. But really at this stage we think that as crude oil sells into any major levels, we'll not only be looking for double bottoms, but we'll be looking to see whether or not this creates sort of like an inverted head and shoulders pattern or something bigger picture. So definitely short short-term bearish crude oil, but we're going to be, as we go into September, looking for bigger bottoms. Next year, I want to take a look at gold futures, and gold continues to be predominantly weak. This consolidation that we've seen over the last month is now creating a big horizontal triangle consolidation point. Really, at this stage, we've always been targeting the 1440 level on the downside for gold, but right now the measured moves even suggest a move as low as 1400 or even 1380 if we get a solid break on gold. While in the bigger picture, we'll be looking for buying opportunities at gold. There is definitely immediate downside risk in gold futures. Next year, I want to take a look at the S&P 500 on a weekly chart. And as always, we plot an 80-week moving average on there to depict the bull and bear market cycles the market has gone through. We continue to consolidate above that 80-week moving average, which continues to suggest a longer-term neutral stance. But we do want to point out that that line in the sand is around the 1300 level, a level that we have violated in the past, and with the S&P futures working their way down to the 1340 to 1330 level, any substantial downtrend could actually have a violation and change the bigger picture stance into a corrective pattern. Nonetheless, we are going to be watching what the prices of the S&P 500 do as it comes towards that support line. When we take a look at the S&P 500 in the daily charts, one thing that we've been very predominant about after the banging at that short-term bottom in the first week of June was that this was going to be a big rising wedge. And while it has actually been extended to even a 6-7 week pattern that has done even a 78% retracement on the upside, we still are predominantly convinced that there is still yet another sell cycle, and this morning's price action is certainly supporting that. Really at this stage, as we break this 1340 level on downside, if we don't have a miraculous recovery this morning and has any follow through down towards 1320, we could at minimum be seeing an S&P that has to retest the lows around that 1275 level on the downside. But if we see any follow through, there are scenarios after the putting in this top that we've been looking for. There are scenarios that even suggest drops down to 1260, even as low as 1200 on the downside on this push. Now, if we were to use any proper wave theory, there is always a chance that this could be a middle wave, which in the past has can be the longest wave. So there are scenarios that could be pretty bearish if the selling really accelerates here. And while we don't want to fear monger here just yet, we do want to stress the importance of risk management at this juncture. And if anyone was wanted to deleverage risk in their portfolios, this is about as good of a time as any. Just to make some key intermarket observations, we are predominantly bullish the U.S. dollar, bearish commodities, bullish those U.S. bonds. We are short-term bearish U.S. stocks, and recognize that the global stock markets are very much embedded in even a long-term bear market, and it's actually the U.S. equity markets that have been holding up surprisingly well. In the bigger picture, this trend that we've been talking about, something we forecasted back at the start of the year, and we still see it in place. There is a genuine chance that over the next few upcoming months that we could see a dynamic change in that, but right now the remaining in trend here is still very much in place. That was your Monday Futures Market Outlook. Thank you for joining me.